Hi guys, Max here, and this is of course your daily market update for yesterday, the 26th of July, and things really weren't too good, especially in the world of tech and financials, as you can see from this heat map behind me. The S&P 500 on the whole fell by 1.2%, the Nasdaq fell by 2%, and the Dow Jones fell by 0.7%. Now we'll get into exactly why that was in a moment, but in general, this is earnings season and things aren't looking great. We're also still headed towards a recession. The Federal Reserve is still tightening, and there's still loads of tensions surrounding our relations with China and Russia and things like that. Basically, this is just the markets reacting to the same sort of news and the same sort of stuff that we've seen for weeks on end now. Across the rest of the world, things weren't too brilliant either. The Americas were a little bit red. Europe was almost exactly flat, with the FTSE 100 and the Stoxx 600 basically not moving at all for the day. But then Asia was quite poor too, especially outside of China. The MSCI World Index then fell by 0.9% for the day. As is now so common when we see equities rout for the day, the dollar strengthened, this time by about 0.5%. The euro fell back down by about 1% to $1.01, getting very close to parity once more. The British pound fell slightly down to $1.20, and the yen was pretty much little changed, actually at 137 per dollar. In the world of fixed income assets, we actually didn't see any major volatility, with the US 10-year Treasury yield not really changing at all and still sitting at 2.80%. The German 10-year yield did fall slightly by 9 basis points, and the British by a little bit less at 2 basis points, but no major changes there. Just some slight movements into risk-off assets as people just get a little bit worried about how stocks are going to perform. For commodities then, oil prices fell by almost 2%. WTI crude is down to $95 a barrel, and Brent crude is sitting at about 100. This is really for the same reason as the same stuff we've been talking about for months as well. The worldwide recession is pretty much here. Everyone realizes it at this point, and so oil demand is expected to fall into the future as people's demand for consumer goods and for everything like that just starts to decrease. We aren't actually there yet though, so this is still speculation and futures and investors doing their work. And then finally, gold prices are still pretty much unchanged, sitting at $1,730 per ounce. In the world of crypto, actually it was rather good and far better than the world of equity markets, with most cryptocurrencies rising on the whole, not by huge amounts though, less than 5% almost everywhere. Bitcoin up by about 1%, still sitting around $21,000 though. Ethereum just above $1,400. Most coins aren't going to be at levels that you'll be surprised to see them at, sitting at about where they were just a few days ago. Now, what was the major news for the day? Well, there were a few big pieces actually, so this might be a little bit longer of a video than usual. We'll start off though with US consumer confidence, because we got new data out yesterday, and this is a really important figure. There's this idea that consumer confidence is sort of a self-fulfilling prophecy, because when consumers are unconfident about the future, when this level is low, they aren't sure about their jobs, they aren't sure that they'll be able to make their car payments or pay off their mortgage, so they spend less money, and this then ripples out into the rest of the economy, and it can actually cause a recession in and of itself, just through lesser spending from consumers. Now, what is the data that we got then? Well, it wasn't good, and we got a brand new low since the bottom of the coronavirus pandemic for US consumer confidence data. So basically, US consumers are less confident than ever that things are going to be good in the future. This is now the third consecutive monthly fall, which obviously isn't good either, but it does make perfect sense. The reasons for this fall are pretty simple as well. Inflation in general, but in particular, gas or gasoline prices going up and food prices going up. People are really worried about those two major expenses on their monthly and weekly outgoings. Now, in my opinion, consumer confidence is actually going to get worse, not better, and we haven't seen the end of this slide. Inflation is still ridiculously high, as I'm sure you know. The Federal Reserve is going to continue to hike rates as we go into the future. Again, I'm sure you know that, and that's going to make things even harder for consumers. Your credit card debt's going to get more expensive. Your mortgages and your car loans are going to get more expensive. The real recession is only just kicking in, so we shouldn't expect this to be a bottom at all, in my opinion. Of course, we're also getting loads of news of mass layoffs or major companies slowing their hiring into the future. Literally today, we got brand new news that Shopify is going to be firing 10% of their staff, or about 1,000 people, and everywhere you look, it's really the same story. This graph here actually encapsulates everything perfectly in my opinion. I'm just going to slide my face out of the way so you can actually see it. This is real weekly wages for American consumers over recent years. And as you can see, over the last year and a half, 2 years since the end of the COVID pandemic, since we started getting back into work and since inflation started taking off, people have been poorer every single week. This kind of data makes it so damn obvious, in my opinion, what's really happening. Of course, I made a full video about the American recession and how the US government is lying to you about it yesterday. So if you haven't seen it, go and look at it. But basically, they're telling you that all the data is strong and that you're delusional for thinking that things aren't good. They are lying outright, and they're just simply ignoring this kind of data, which looks at the simple money in your pocket at the end of each week, and they're just saying that it doesn't exist. Is that mostly why markets fell then? Well, yes, but also there are some other bits of bad news too that we'll get into in a moment. Of course, we had Walmart's profit warning yesterday, which sent markets into a little bit of a tailspin. We're also expecting a major rate hike on Thursday from the Federal Reserve. And a big narrative that's growing and growing these days is the idea that the soft landing, the idea of getting inflation down without causing a recession, it's pretty much out of the window. And this quote here summarizes that pretty well. A soft landing feels like a long shot from here. In the last 11 tightening cycles, the Fed has only skirted recession 3 times. In each of those cycles, inflation was lower and the Fed funds rate was meaningfully higher at the point of liftoff, so Fed tightening didn't need to be as dramatic as it does today. Basically, every single time in history that the Fed has actually achieved a soft landing, conditions were far, far better and it was far easier for them to do so than it is today. In my opinion, it's over. The idea of a soft landing is off the table. A recession is 100% here, and it's probably going to be here tomorrow when we get that new GDP data. And if it isn't, well, it will definitely be here within another 3 or 6 months. Now, we did actually get loads of new corporate news because, of course, it's earnings season. So to start off with, we'll have a look at Alphabet, or as you know them, Google, and their earnings, because they are a massively important company. They have been worth $2 trillion in the past. They are the ad giant, the ad dominating force of the world, and they're a bellwether for every other company that makes money from ads as well, like Snapchat or Pinterest. Now, on this earnings report, their shares were up by 5% after hours. So it must have been a really amazing report then. Well, no, not really. It was actually a little bit bad. So this is all a little bit weird. Now, what was the actual data? Well, for revenue, Google missed expectations, achieving $69.69 billion versus $69.9 billion expected. Earnings per share was a miss as well of $1.21 versus $1.28 expected. YouTube's ad revenue was a miss of $7.34 billion versus $7.52 billion expected. Google Cloud's revenue was a miss with $6.28 billion versus $6.41 billion expected. Google was actually weaker than expected in almost every single area. The only place where they really did okay was some costs were down for the quarter. Their revenue growth is down to 13% year over year compared to 62% from 1 year ago, and they've refused to give any guidance for the next quarter because they are uncertain about how the market condition is going to affect their business over the next 3 months. Now, why was this earnings quite bad? Well, the dollar's strength eats into their profits because they are, of course, an international company. A huge amount of their revenue comes from overseas. And when the dollar is stronger, I still pay Google the same £10 a month for a monthly subscription, but that £10 is now worth fewer dollars. So that cost them about 4% revenue growth, which isn't good. And then there's also just this general massive slowdown in advertising revenue because companies are spending less because of this recession that we're starting to enter. Now, why did the share price rise then on this bad news? Well, it's a little bit difficult to say and it doesn't make perfect sense, but investors do seem to expect Google to do well in the future, even without any guidance given this quarter. That's probably mostly why the share price rose despite missing all of these expectations. There's also the idea that Google is just a better place to have your money than any other company. Frankly, I'm not buying Google, but if I were forced at gunpoint to buy an American company today, it would probably be Google. Of course, we also got Microsoft's earnings report for the same quarter, and it was pretty much the same story as Google. The share price was up by about 5% in after hours trading. So it was a really good report, right? Well, no, again, it wasn't. They missed on most aspects. Revenue was a miss of $51.87 billion versus $52.44 billion expected. Earnings per share was at $2.23 versus $2.29 expected, so both misses there. Revenue growth was at 12% year over year, which is really low for Microsoft. Their net income was at 2% year over year growth, which is very, very low for Microsoft. They're seeing the same problems as everyone else, the same problems that Google is seeing as well. Ad revenue falling just due to the recession, the strong dollar hurting their income from overseas. Microsoft Azure, which is their cloud computing part, which is designed to compete and to take market share away from Amazon Web Services, is starting to struggle a little bit and isn't growing by as much as they would have liked, just like Google again. Microsoft did actually give expectations for the next quarter, unlike Google, and those expectations, this guidance, this forward guidance, is actually really strong. So that may be one of the reasons why Microsoft is up. But again, it's just probably one of the best places to have your money right now, because inflation, you're guaranteed to lose 9% a year. Any stock, you're guaranteed to lose money over the next year as we enter a recession. But maybe Microsoft and Google are going to lose you less money than the other alternatives. Now, in the last bit of corporate news for today, we also got Visa's earnings, and this one was actually the opposite story to Google and Microsoft. It was good news on the surface, but investors weren't too confident, and so in after-hours trading, Visa's share price was actually down very slightly by about 0.5%. Now, at first, their share price jumped by 3% on the news, but then it went down to par those gains and end up down. And as I speak right now, again, it's down a little bit from where it closed yesterday. So what was their actual news? Well, on revenue, Visa beat expectations with $7.28 billion versus $7.07 billion expected. Earnings per share was a beat as well, with $1.98 versus $1.75 expected. Their payments volume was up by about 12%. So they beat their expectations across the board, but the share price was still mostly flat and even a little bit negative. Why is that? Well, it's really hard to say, but in my opinion, Visa seems to be just about keeping up with inflation, but you would expect that from a payments processor because people are still spending all the money they have and they're still going to use their Visa cards. So Visa should actually benefit from this inflation, but it doesn't really seem to be benefiting, just holding up with expectations. It's also worth noting that real inflation is far, far higher than the Federal Reserve's figures. As we all know, that data is practically fraudulent. And so just keeping up with inflation maybe isn't enough. We also have news coming from Walmart, which is still down, its share price down 7% from yesterday. We spoke about it in yesterday's video, but they gave a massive profit warning because they're not sure about how they're going to perform in the recession. Shopify is also panicking about how it's going to perform. It's just announced it's firing 10% of its staff because it can't reach its targets. And Visa is in a very similar business to these businesses. People buy their stuff from Walmart or Shopify, yes, but they buy them with Visa or MasterCard or Amex cards, and that isn't going to change. So if these companies suffer, well, in theory, Visa should suffer as well in the long run at least. All in all, this earnings season is just looking really weird and incredibly volatile. Visa did well, but then its share price fell. Microsoft and Google did badly, but then their share prices rose. Even when we get seemingly good news across the board or bad news across the board, markets aren't necessarily reacting how we would expect them to. Now, to finish off for today, we're just going to do a very quick fire round of 3 little stories. Firstly, we have Liz Truss, who is, in my opinion, very likely to be the next British Prime Minister, and she's already creating new tensions with China. She basically said that the UK needs to crack down on Chinese firms like Huawei and TikTok and focus on national security, which is a very fair thing to say, but China's very angry about that. They're not happy, and so they're putting out rebuttals. This is fully expected. Tensions to get worse between the two states, between East and West, and decoupling of supply chains to happen eventually in the future, which will impact markets. It will reduce earnings for companies, it will increase costs, and all sorts of things like that. The second little bit of news is that the tensions with Russia are not getting any better either. The Russian gas squeeze is still ongoing in Europe, and at this point it seems that they have just condemned Europe to a massive recession and that things are really going to get quite bad, especially as winter comes and gas prices stay ridiculously high. There just doesn't seem to be a way out for Europe here. Finally then, this Coinbase versus the SEC fight is getting a lot of publicity, and this is for good reason. It's an incredibly important fight point for the future of cryptocurrency. We should expect loads of news on this. I plan on covering it quite in depth because the regulation of crypto could change this industry in its entirety. It could make it absolutely worthless or guarantee that it does go on to become the future of finance. In regards to Coinbase in particular, this could again be either really, really good or really, really bad. This could actually kill a company like Coinbase if it comes out that crypto is a security and they haven't been trading with any of their appropriate regulations. So watch out for those 3 little bits of news there. If you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. It really does help. If you want to join our exclusive community, then check out our Patreon. You get access to our Discord server and extra content like access to my portfolio and buy and sell alerts for all my own investments. Also, make sure to check out the link in the description to Masterworks. It can help you protect your portfolio against market turmoil through fractional shares of art from world-famous artists. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets falling every week. There's also a link in the description to Trust Capital, which helps you to invest in crypto through your tax-advantaged IRA, which could literally save you thousands. If you, like me, think crypto going down is a buy-in opportunity, then now is the perfect time to join Trust Capital. Thank you all for watching. Stay stoic. Until next time.